In this lesson, we're going to look at fraud in the context of the audit. So let's put our auditor hats back on. Audit standards require us to maintain a level of professional skepticism, which doesn't mean that we need to be paranoid of fraud. Instead, it simply assumes that management is neither dishonest or honest as we conduct our audit. This requires us to set aside any predispositions we might have about management. Remember that we are responsible for obtaining reasonable assurance that the financial statements are free of material misstatement, whether arising from either errors or fraud. So how do we demonstrate that we have exercised professional skepticism during the audit? Well, firstly, by simply considering the potential for fraud during the current audit. Second, by scrutinizing all documents for authenticity. And unless there's evidence of tampering, we can accept the documents as genuine. Third, by following up on any inconsistencies between the audit evidence and the inquiries with senior management and the board of directors. Representations of management alone are not sufficient evidence and require us to corroborate from other sources. The audit team must maintain and display a level of fraud awareness throughout the different phases of the audit. During the pre-planning phase, we will consider the potential for management bias. We will also document in the engagement letter that management is responsible for fraud. And during the client risk profile assessment, we will note any pressure or business practices that could lead to a rationalization of fraud. We will evaluate the client's risk management processes. During the preliminary analytical reviews, any unusual transactions or trends that might be indicative of a fraud will be identified. And these findings will be discussed with management to obtain their view of the risk of potential fraud. We will listen to what they have to say and determine whether the fraud measures the client has in place adequately mitigate the risks. During the audit planning phase, we will document the fraud controls and evaluate the effectiveness of these controls. We will also assess the risk of fraud in an overall context as well as in areas where fraud represents a potential risk of material misstatement. Now, fraud risk factors do not indicate that fraud exists, only that the likelihood of fraud is higher. And in situations where the risk of material misstatements due to fraud is high, we may call upon a fraud specialist to join the audit team. Finally, the audit team will be briefed on the risks of fraud in the current engagement. The briefing will include how and where the financial statements might be susceptible to fraud, how management could perpetrate and conceal a fraud, how assets could be misappropriated, circumstances that might lead to earnings management and fraudulent reporting, any internal or external factors that might pressure management to commit fraud, opportunities for fraud to be perpetrated, any conditions present that might allow management to rationalize fraud. Remember the elements of the fraud triangle. And finally, how the audit team should respond. The audit programs will be tailored to include procedures that address the risk of fraud. And there are several areas that are always assumed to have a significant risk of fraud, unless there is evidence to the contrary. And those include, first of all, revenue recognition. As we discussed in previous lessons, there are a lot of ways to manipulate revenue, including misrepresenting bill and hold arrangements, channel stuffing, manipulating returns, understating bad debt allowance. Management override is perhaps the most significant fraud risk of a material misstatement, and we tend to focus procedures to address this risk specifically. We will study the internal controls over journal entries. We will inquire of personnel of any unusual activity and test the journal entries to ensure that each adjustment is adequately documented. Accounting estimates are particularly easy for management to manipulate. So here we will look at the consistency of the methodology as it's been applied from year to year for any indications of bias. For any unusual transactions, we will want to understand the business rationale. We are looking for transactions that require incremental disclosure or lack commercial substance, such as wash trades or specific related party transactions. In the test and control phases, we will test the fraud controls and reassess fraud risk if necessary based on the results of the testing. That is the same story that we have talked about previously in the context of relying on internal controls. And during the substantive testing, the auditor will perform procedures that address areas of significant fraud risk. During the field work, the auditor will be alert for red flags that might be indicative of fraud, such as discrepancies in the accounting records, conflicting or missing evidence, or uncooperative management in gathering evidence. Keep the old adage, where there's smoke, there may be fire in mind as you are conducting your audit work. In the evaluation phase, the reviewer will look for any inconsistencies or any unusual results that could be indicators of fraud to ensure that the adequate investigations have been carried out by the audit team. And lastly, during the reporting phase, we will communicate with the audit committee and management any findings pertaining to fraud. Now, fraud can be uncovered through a variety of common audit procedures. The auditors will make inquiries of management and the audit committee, and the auditor will ask management how it has addressed previously identified weaknesses, if at all. The auditor will also ask management or the board of directors if they have any knowledge of frauds or suspected frauds within the company. The auditors will make similar inquiries of the internal audit function and discuss the extent to which the internal audit function has performed any work to identify frauds during the year. As the auditor talks to more and more people around the organization, evidence is going to be gathered that should corroborate those initial inquiries with management, the board, and internal audit, which may trigger follow-up procedures to support or refute the original risk assessment. Analytical procedures are also a good way of uncovering potential frauds. Take revenue, for example. If management overstates revenue, then the gross profit would be higher than expectations, which in itself might be explained away. However, because of the nature of double entry bookkeeping, the other side of the entry is often to accounts receivable, of which an increase in and of itself can also be explained away. However, if you calculate the accounts receivable turnover and notice that it has slowed at the same time the gross profit margin has increased, this is a potential indicator of a sales overstatement. The same sort of combination of analytical procedures can be used to uncover an inventory overstatement. Ending inventory is higher, reducing cost of sales, leading to an increase in gross profit percentage. However, at the same time, there is a decrease in the inventory turnover, which could be an indication of inventory overstatement. Since fraud perpetrators are often knowledgeable about audit procedures, one way to counteract this risk is to incorporate unpredictability into the audit plan, even if such amounts are immaterial. For instance, smart fraudsters know that it's hard to detect a series of smaller thefts than it is to detect one larger one. So the auditors need to maintain an awareness beyond what's simply prescribed by the audit program, so that when they notice something that's odd, such as a series of small payments to a particular vendor, they follow their curiosity. And because fraud schemes are so widely varied, detecting them requires equally varied audit procedures. The response to each fraud risk is often unique depending on the specific circumstances. Now, computer auditing is also an effective way of uncovering potential frauds. The procedures the auditors can perform using a CAD include extracting unusual transactions for further scrutiny, detecting gaps in serial numbers of invoices or purchase orders, recalculation of any such things as aging, matching of different pieces of information, looking for any inconsistencies. So for instance, if you have an address in the vendor master file that matches an address in the employee master file, there may be an indication of a potential fraud. You may also perform statistical and trend analysis. Now, Benford's law is a cool way of looking for fraudulent transactions that has been buried in the accounts. This law suggests that certain digits, such as those from 1 to 9, appear disproportionately in a given population. So, for instance, the number 1 or the digit 1 should appear 30% of the time, whereas the digit 9 should appear only 5% of the time. How would you apply this to an audit? Well, you could use a CAT to calculate the distribution of digits in a general ledger and see if there's a disproportionate number of the digits. It too could indicate that someone has been fixing the books. And when someone starts making up numbers, the tendency is to equally distribute the digits in the fraudulent entries. So as you can see from this discussion, the auditors are well immersed in looking for fraud during and throughout the audit. So what happens when fraud is detected? What is the auditor's responsibility? The auditor should discuss the suspected fraud with the appropriate level of management, which is generally speaking one level above those suspected of the fraud. If senior management is suspected of fraud, then the discussion should be with the audit committee. If the audit committee is believed to be corrupt, then the auditor should consider withdrawing from the engagement. Normally, the auditors do not report suspicions of fraud outside the client organization. In completing the audit, the auditors will communicate certain fraud matters to the audit committee as they pertain to such things as management integrity, or the lack thereof, any fraud involving management, any fraud involving employees involved in the financial or internal control process, any frauds that, while not material now, could be material in the future. So we've covered a lot of ground in this lesson, and even though fraud is primarily a management responsibility, that does not absolve the auditor of assessing the risk of fraud causing a material misstatement. This in turn has implications throughout the course of the audit engagement and requires the audit team to maintain an alertness for potential fraud. Until next time, don't stop to get to the top. When you get to the top, don't stop.